Welcome back, and we're continuing to work through the retiree years step in the Wealth Steps order of operations, and we're going to talk a couple minutes about the portfolio expectations and real estate strategies. So there's two scenarios that frequently show up to my office here, and one of them is showing up with a portfolio that might be less than $300,000 or $500,000, and those individuals, their income streams and their retirement income situation is going to be completely different than an individual that shows up with $3 million. And I'll just give you quick numbers here. So ballpark figure, if you took out 4% of, let's just say, a $2 million portfolio, you're looking at $80,000 a year. So a lot of individuals, they're already living off of less than $80,000 a year. They've lived modest lives throughout their working careers. They saved a couple $1,000,000. They're what you would call everyday millionaires, and they spent 30 years working hard, stashing away, and now they got a couple $1,000,000. So a lot of times they're not going to change their lifestyle, going from, hey, I'm only living off of less than $80,000 a year now, and now I want to live off $250,000 a year. That usually doesn't happen. A lot of times individuals, they're going to continue with the same level of lifestyle. Not always the case, but a lot of times, yes. So for an individual that has, let's just say $3 million in their portfolio, that portfolio most likely can withstand a 4%, 5%, 6% withdrawal rate. And you got to run your own numbers here. It is more of a risk-based decision, but that individual can live off of the portfolio, and they can make a bad decision on Social Security timing or even some other financial situation, and most likely because the income is so high living off that kind of portfolio that it covers a multitude of bad financial decisions in retirement. Now, for the individual that, let's just say, has less than $500,000, that individual, I'm going to argue, needs a financial advisor more so than the individual that has $3 million in a portfolio. And why do you say that? It's because every decision has to make sense and it has to be correct. There's a lot less ability to forgive financial mistakes when you have less than $500,000. So you're probably thinking, well, what decisions do I need to make sure that I master my retirement? Well, one is figuring out what kind of amounts you have in your retirement portfolio, your 401k, 403b, some other type of retirement accounts, and figuring out, how much can I pull out over a span of, let's just say, 30 years, and that's going to give you a number. Maybe it's $5,000, $20,000, $40,000. Doesn't matter. We got to figure out, okay, how much can we pull off the portfolio and not completely drain the portfolio to zero, unless you truly want to die with zero. And there is a book called Die with Zero. The premise is, figuring out spending the max amount of money you possibly can, and so you're not leaving any money to anything else when you pass away. But ultimately, we don't know when we pass away. So we got to figure out, what kind of portfolio would sustain a 4, 5, 6% withdrawal rate. Generally, it's going to be something along the lines of a multi-asset class portfolio, to where it's not just stocks and bonds. It's not your 60-40 traditional portfolio. It's going to be something that is going to withstand a larger drawdown of 30, 40, 50%. So without getting too much into the weeds, you need to know what is the drawdown of your portfolio. So if you've got a portfolio that's made up of 100% stocks, 100% equities, and 0% bonds or fixed income, you're going to experience a portfolio drawdown that's much more higher than a portfolio that might be, a 50% stocks and 50% bonds, or a multi-asset class portfolio. And this gets into a lot more of advanced portfolio styles. And if you've spent 30 years outsourcing your portfolio management to someone else, you may not even want to learn what the other styles are, but that's completely up to you. A lot of people, they go into retirement and they have a lot of extra time, and so they start studying these different portfolio styles, whether it's a multi-asset class portfolio that's designed to withstand a larger drawdown. It's not going to completely blow up your retirement because you just lost 10, 15%. Now, if you lost 40 or 50%, it might completely derail your retirement. And that scenario is called sequence of returns risk. So if you go to Google, type in sequence of returns risk, things are going to start making a lot more sense once you understand that. But you've got to understand, what is your portfolio built with? Is it built in a tax deferred account, a tax free account? And then what are the funds inside of that account? Is it index funds, mutual funds, individual stocks? Figuring out what your risk profile is for that portfolio is a major decision that you need to make. So is your portfolio going to drop 10, 20, 30, 40, 50% based off of what assets are inside of the portfolio? That's the decision. That's the question that you have to answer. I thought I was going to have a little bit more time to go into talking about real estate strategies in retiree years, but let's just round this episode out. And we've only talked about portfolio expectations. This is an area that I really enjoy. I like portfolio management. I do portfolio management for clients through Portfolio Medics, which is a registered investment advisor that I'm affiliated with. They have a couple of different buy and hold strategies. They have a couple of active management strategies as well. But this episode ultimately is about education. If you want to further that conversation, feel free to reach out. But let's wind this episode down and let's talk about real estate strategies in the next episode.